If you've been waiting for interest rates to come down before buying a home, you really need to watch this. This is the Market Brew. Hi everyone, Mike Tilford here. Interest rates are still above 7% and prices don't show any signs of coming down in most areas. With rates predicted to start coming down in the fourth quarter of this year and throughout next year, it makes sense to wait. At least, that's what many people keep telling me. Sorry to break it to you, but it's probably a bad idea. At least if you don't want to lose money. I know a lot of you hate math, and if you're like me, you just kind of zone out when the numbers start rolling. So I promise to keep it as basic and simple as possible. So to figure out what's best for the present, we need to look at future predictions. Most importantly, we need to look at where interest rates and home prices are predicted to go. As I said already, interest rates are predicted to start coming down sometime in the fourth quarter of this year and continue to do so throughout all next year. There is some disagreement as to how much and how quickly rates are to come down. Fannie Mae is a bit more conservative in their predictions, and the Mortgage Bankers Association is much more optimistic. Fannie Mae predicts rates to hit 6% by the end of next year, while the Mortgage Banker Association predicts rates to hit 5% by the same time. It's safe to say that reality will fall somewhere in between. Now let's take a look at home prices. In a national sense, home prices are expected to continue to rise. This is in the largest sense possible and does not apply to every city and neighborhood. Remember, real estate is local, but these broad national trends are good enough indicators for the market as a whole. If you look at this chart, you will see the price change month over month and the expected total increase by the end of 2023. Based on this data, by the end of the year, home prices will have increased between 5 and 10%. This trend should continue through 2024 without any outside stimulus, likely even accelerating with interest rates coming down. So here's a nice little graph courtesy of Mike Wise from CMG Home Loans. I'll post a link to his channel in the description below. Say you were to buy a home today for $900,000. With 20% down, the loan amount would come out to $720,000. And with an interest rate of 7.25%, your monthly payment would be $4,912 per month. Now, based on the interest rate predictions and rising home prices, here's where we may stand a year from now. With prices continuing to increase, that same home is now $975,000. A 20% down payment is $780,000, but with the lower interest rate of 6%, your monthly payments would only be $4,676 per month. That's a savings of $236 per month, which looks pretty good on paper. However, if you were to have purchased today and refinanced in a year at that lower 6% interest rate, your new payments would be $4,316 per month, which is $360 per month less than your theoretical future sale, and almost $600 per month less pre-finance. In addition, you would have also gained $75,000 in equity over the first year, which you wouldn't have done were you to wait to purchase. Buying a home now doesn't look so bad after all. Remember, there is no guarantee that these numbers will be accurate in 12 months. They are merely a prediction based on what we know right now. But it goes to show that there is more to purchasing a home than interest rates alone. With home prices continuing to go up, it is a good idea to purchase now at a higher rate, earn that extra equity, then refinance back down to a rate you are more comfortable with in the near future. Now this is all bare bones look at what is possible, and if you're interested in going into more detail and figuring out a loan that is more tailored to your current situation, then give me a call and I can point you in the right direction. Well, that's it for today. I'll see you next time, and as always, I'm never too busy for your referrals.